Hey guys, thanks for tuning in. Today we're going to cover 8 ways that you can build or rebuild your credit. This channel is dedicated to helping you understand your credit better, personal finance, and just understanding the various types of loans that are out there and available to you. So if that's the type of content you like or are interested in, make sure you smash that like button and subscribe and stay tuned for future videos. Alright, let's get right into it. 8 ways to build or rebuild your credit. Number 1. Now this may seem obvious, but pay your bills on time. And I'm talking about everything. Credit cards, personal loans, auto loans, mortgages, rent, utilities, whatever you have outstanding, make sure you pay your bills on time, every time, as this is the biggest driver of your credit score. And if you don't pay your bills on time, that can lead to more negative things on the credit report, such as charge-offs and collection accounts, which will drive that credit score down even further. One tip that I have for you is to set up your payments on automatic payments to come from either your savings account or your checking accounts monthly. Let's face it, you have so many other things to worry about. It's easy to forget sometimes, so therefore make it easier on yourself. Set things up automatically. Set it and forget it. All right, number 2, start small. It's not realistic for you to think that if you have bad credit or no credit, that you're going to get approved for large sums of money. Think small. When you go in, maybe ask for 500, ask for 1,000, something small that you can demonstrate your payment history on by paying those payments on time every time. And if you get those small amounts and you do well on them, that's just going to improve your chances for larger amounts on the next time you apply, and so forth and so forth. All right, number 3, apply for a secured credit card. What is a secured credit card? Essentially, it's a credit card that's secured by cash money. In this type of instance, what you're going to do is you're going to take, let's say, $500, and you put that into your savings account. Well, the lender, they can pledge that money or put that money on hold and use that in order to give you a credit card. So therefore, it's very low risk to the lender, because in the event that you don't make your payments or the credit card balance goes bad, the lender can use that money that they have on hold and use that money to pay off the balance of the credit card. So again, virtually no risk to the lender, and a very high a very high probability of you getting approved for that type of product. All right, number 4, examine your credit report annually. You're entitled to one free copy of your credit report a year from each of the 3 major credit bureaus. So that means you can get 3 copies of your credit report free a year. So what I like to do is 1 month I'll get a credit report from, let's say, TransUnion. 4 months later I'll get my second credit report from Equifax. And then 4 months after that I'll get my third credit report from Experian. What that allows you to do is to stay on top of your credit, monitor it so you can see what's being reported out there for you or about you on your credit, and it'll give you the opportunity to examine it for errors, for mistakes, and if there's anything out there on your credit report that's not right, you can file a dispute with the credit bureaus in an effort to try to get that removed. All right, number 5, do not switch employers more often than you need to. Lenders like to see job stability, because more than likely your primary job is going to be the primary source of repayment for the loan that they're looking to lend you. So if you're jumping around from job to job to job and your job stability is not consistent, then the lender might look at it as your repayment source is not going to be consistent either. What I suggest is, a minimum, try to have at least 6 months on the job before you apply for something, and that'll give you a better chance of getting approved. But in this case, longer is better. All right. Number 6, work hard to increase your income. There's nothing more than lenders like to see than for your income to increase steadily year over year over year. If your income can do that, chances are that the lenders are going to be knocking on your door trying to offer you credit. See what you can do to improve that income, whether it's getting a second job, getting a side hustle, working harder at your existing job so you can make promotions. But try to increase that income, and that'll make your chances for future lending even better. In addition to that, make sure when you're applying for loans, make sure you're not leaving anything off the table. For example, you might have your primary job, But think about other things that you might have going on for you. Do you have other sources of income like Social Security income, disability income, retirement, or pensions? So when you apply for those loans, make sure you think of everything you have income-wise coming into you and make sure you get that listed on the application. All right, number 7. It's really the opposite of number 6. Work hard to decrease your existing debt. The more debt you have, that's going to affect what's called your debt to income ratio. And we'll cover more in detail what the debt to income ratio is in a future video, but just know this. If you're increasing your income by, let's say, X amount, but your debt is increasing by a faster pace, that's not a good thing. That's going to affect your debt to income ratio, and realistically, it's going to make the lender think twice about lending to you. Lenders have certain ratios that they're comfortable with lending on, so before you apply for a loan, feel free to ask your lender, what's the comfortable debt to income ratio that you like to see? And they can more than likely share this information with you. And if they're able to share that information with you, then again, you'll know that information ahead of time before applying for the loan. But the moral of the story is work hard to decrease your existing debt obligations, and that'll help you get your chance of getting approved for future loans. All right, and the number 8 way to either build or rebuild your credit is to avoid co-signing on loans. Now you might want to be nice and think you're helping out this person. It could be a friend, it could be a family member, but my suggestion is you just don't do it altogether, because essentially what you're telling the lender is that if this primary person is not able to meet the obligation, that you're going to come in and meet that obligation for them. And think about it, there is a reason why this primary person can't get approved on their own. It might be that they have no credit, or they might have bad credit, and essentially you're just setting yourself up for potentially a uncomfortable situation, because if they go bad on the loan, then that leaves you on the hook for the loan, and probably going to leave you a little bit sour toward them, and it could affect the relationship. So again, if at all possible, avoid co-signing on loans. You're better off just teaching them ways that they can improve their credit, share this video with them, and that'll be better off serving you and serving them down the road. All right, that concludes the 8 ways today that you can either build or rebuild your credit. Now, there are additional ways that you can build and rebuild your credit, and we'll cover additional ways in future videos. But if you like this content, hit the like button, subscribe, and stay tuned for future videos. Thanks for tuning in. Take care.